This chapter is a really difficult chapter and it introduces two concepts called bad debts and doubtful debts. So before we learn how to process them, we better learn what they are. And the whole thing comes about because when a business sells on credit, which is what we've been doing for most of the year, there are pros and there are cons. So let's start with the pros. The pros are it attracts customers to the business and increases sales. So for example, Harvey Norman, you often get 60 months interest free, which is effectively a credit sale. That's a great way to attract customers. It allows customers to buy from the business who otherwise may not buy at the moment because they don't have the cash. So not only does it attract customers, but it kind of brings forward sales they wouldn't have made until the future, but it brings them forward to today. It can be used in our marketing as a way to promote the business. And together, these are some pretty strong pros. But this chapter is all about this cons column. And we've got a few. First of all is when you make a credit sale, there's a delay in receiving the cash after the sale versus when you make a cash sale and the money is received instantaneously at the same time. Secondly, there's going to be a cost of managing and collecting accounts receivable. People and time are needed to know which accounts receivable owe what, when they're due, and then chasing them up. That can be really complicated. But this last con is the one we're talking about in this chapter, which is there's always going to be a risk of non-payment from accounts receivables. People who bought on credit but either don't pay, can't be found, or maybe don't pay all of it. And that's going to lead to what we call bad and doubtful debts. So the fact there is a risk of non-payment from every accounts receivable leads to two things. Let's start with a bad debt. That is an amount owing from an account receivable that we say must be written off as irrecoverable or uncollectible. And all that means is the account receivable is not going to pay. And that is certain. And it's because the account receivable is unable to pay. Maybe they're in liquidation or bankruptcy, or maybe we just can't find them. They've skipped town. The point being, it's irrecoverable or uncollectible, and we know that. It's 100% certain that the bad debt won't pay us. And what we think of that is it's a specific account receivable. We can identify them by name. A bad debt, we know what their name is and we know how much they owe us. And when we get to further in this chapter, we're going to look at how we record it, and we're going to say this is an expense called bad debts. What is a doubtful debt? That's an amount owing from an account receivable that is unlikely to be collected in the future, but it hasn't been written off yet. So up here with bad debts, we said it's something that's, or an account receivable that's 100% certain is irrecoverable or uncollectible. But here, it's not certain, it's just unlikely. And what we say is it's because we think it's unlikely that a doubtful debt will pay us, but we're not 100% certain of it yet. In fact, we mightn't even know who it is. What we do know is that we've got $100,000 of accounts receivables. It's probably pretty likely that a certain percentage of them won't pay. We might not know who they are, but it's just a fact of business that some people won't pay. So it's likely that some of our current accounts receivable will not repay the business, and we're going to call those people doubtful debts. So up here with bad debts, we said it's a specific account receivable we can identify by name. A doubtful debt is not. It's just out of our accounts receivable, what percentage of accounts receivable are likely to not pay. And when we deal with how to record it, we're going to say this is a negative asset, whereas bad debts is an expense. A little simple way to look at the difference between the two is to say bad debts is when you say, we know that John Smith, who owes us $900, won't repay. We know their name, we know how much they owe, and we know that they definitely won't repay us. Whereas doubtful debts is, we don't exactly know who won't pay us, but we know that each period, around 5% of our accounts receivable simply don't repay their accounts, but we don't know specifically who. What we need to figure out is why we're doing this, and we'll get to the theory later in the chapter, but just to look at it now, let's just take an example. Let's say we made a credit sale to an account receivable called Jerry Seinfeld on July the 1st for $10,000. Later in July, so Jerry hasn't paid us back yet, but we hear Jerry is likely to go bankrupt, but this is not certain. But because it's not certain that he'll go bankrupt, we just heard it, I guess we can't say he is a bad debt yet, so we don't do anything. What we do is we don't hear anything for another 2 months, we let 2 months go by, and even though we heard about this in July, in September Jerry officially does go bankrupt and is a bad debt, and we're not going to get our $10,000. And the problem here is if we don't make an allowance for doubtful debts in July, here's what just happened. We made a sale, which is revenue, to Jerry in July for $10,000. we didn't have an expense of him not paying in July because we didn't know for certain he wasn't going to repay. What we did is we waited until September before we said Jerry is not going to pay. He is a bad debt. And what we've got is a revenue in July now being matched with an expense in September. And that is wrong. It's wrong because we're matching a revenue earned in July with an expense incurred in September, which totally breaches our accrual basis and period assumptions. But we'll look at the theory later, specifically how. And what we say is it basically leads to an incorrect net profit in July. We've got $10,000 of revenue in July, but really, because he never pays, we've got $10,000 of expenses, but we didn't record it in July. So our profit will be overstated or too high. And then we get to September. In September, our profit is wrong. We've got a $10,000 expense called a bad debt from Jerry not paying, but we've got no revenues that period to match it to. And what that means is we'll have an incorrect net profit in September. It will be understated or too low. So while the expense incurred wasn't certain in July, it says here we just heard that he's likely to go bankrupt, we had a good idea that it was likely. So what we should have done to ensure our net profit figures each period are more accurate is we should create an allowance for doubtful debts in July. So let's have a look how we do that. So let's take the exact same example. We're not changing anything here. So what we've got is we're going to say there is a sale in July for $10,000. But what we're going to do is make an allowance because in July we heard Jerry is likely to go bankrupt but not certain. We should plan for that now and record an expense, a doubtful debt, today. And then in August and September, none of this is affected. There's no revenues, there's no expenses in August, there's no revenues, there's no expenses in September. And what we've got here is that when Jerry finally does go bankrupt in September, we're not charging a random expense here which has no revenues to match against. What we did is we recognized it was likely that he'd go broke here in July, and we matched that with our revenues. And this is so much better because we are now matching our revenue earned in the period of July with an expense incurred in July. And our net profit in July is now accurate, and our net profit in September is now accurate. And if Jerry does end up paying us later on, well, we did plan for him to not pay us. We said it's pretty likely he won't, but there was a chance he might. Well, we can easily adjust that, and we'll do that in the next lesson. So how can we identify which accounts receivable are unlikely to repay us? I just gave you an example with a specific name. We said that's probably what we don't want to do. That's option one. We could identify every accounts receivable, go through them all one by one, and sort of rank them and give them a percentage of which ones are the least likely to pay. And we could base that on a couple of things. Their past history, like maybe they've taken a long time to pay, or maybe the account is very old, e.g. 95 days past the due date and so forth. But we don't want to do that. It takes too much time and effort, so we don't do it. It takes too long to go through every single invoice, every amount that is owed to us, and sort of rank it and figure out who's likely and unlikely to pay. So what we're going to do is something called the income statement approach. And all we do is we just analyze our past sales data, and we're going to estimate a certain percentage of net credit sales who typically never repay their accounts. So what we could say is, for example, let's say this period our net sales are 100,000. If we go back and look at our past data, we don't need to know who didn't repay, but roughly 2% of accounts receivable will never repay. So what we can do is make an allowance for doubtful debts. If net sales this period were 100,000, well, we can take out 2% of that as an allowance for doubtful debts. And that's the approach we're going to use because it's going to end up matching our revenues earned with our expenses incurred. So what we're going to do is learn how to do that and how we record the debits and credits and so forth, and we'll do that in the next video.